the hot topic of inflation and what it means for insurance. As we all know, in 2020, inflation has staged a surprising, if not a shock-like comeback. Consumer prices have surged to levels not seen in decades. As a result, the cost of living has developed into a key concern in both mature and especially developing economies. Headline inflation, as we all know, of course, has been receding over the past few months, but core inflation, which is the much more relevant measurement as it strips out volatile items such as food and energy prices, core inflation remains at elevated levels, at uncomfortably high levels, way beyond central banks' targets. And that's why it would definitely be premature to declare victory on inflation. Now, with that topical backdrop in mind, today's webinar examines how inflation continues to affect insurers, what insurers do to respond, and how inflation may change customers' expectations towards the industry and their perception of the industry. When discussing these questions today, we will be able to draw on a research report that the Geneva Association has released just a few weeks ago. With that, let's take a quick look at today's agenda. We will spend the next 20 minutes or so elaborating or sharing the key findings of the research paper, which I just mentioned, and listening to the opening statements of our distinguished panelists. Then we will have a 15-minute moderated panel session among the panelists before opening the floor to you, to all of you, to answer your questions for the remaining 15 minutes. In terms of housekeeping, please be aware that this session is being recorded. And if you would like to submit a question or a comment, please use the Q&A button. So without any further ado, it is now a great pleasure to introduce today's distinguished panelists and experts, starting with Manuel Aguilera. Manuel is the chief economist of MAPFRE. Before assuming this role in 2015, he served as the president of the Insurance Commission of Mexico. During his 17-year tenure as commissioner, Manuel also held preeminent international positions, such as chairman of the International Association of Insurance Supervisors and chairman of the Insurance and Private Pensions Committee of the OECD. Rachel Turk is group head of strategy at Beazley, based in London, and member of the executive committee of Beazley. Through this role, she is responsible for many things, such as developing and delivering the group strategy, strategic projects, business development, business planning, responsible business, and incubation underwriting. Rachel also serves on the board of the Lloyd's Market Association. And last but not least, Li Xing. Li is Swiss Re's head of insurance market analysis. Prior to taking this Zurich-based role, she was deputy director of the Swiss Re Institute China Center based in Beijing. During her 15-year tenure at Swiss Re, she has co-authored and contributed to various editions of Sigma, Swiss Re's flagship publication. And I should also mention that Li has also made an important editorial contribution to the research paper, the Geneva Association research paper, which I just mentioned. So that's a nice transition to precisely this paper, on which I would like to share with you the key messages. Just 2 slides. Here you see the report, of course, downloadable from our website. And I hope that my key messages presentation will incentivize you to take a closer look at the substance of the research. Now, starting with the impact of inflation on insurers' earnings. Here, the effect is clearly negative for non-life insurers through higher claims and through the need to strengthen reserves. We have seen this in many companies' results. On the life side, the impact is more neutral because most benefits are nominally fixed. Think of mortality, of wealth accumulation, of longevity products, for example. Then moving on to solvency. Here again, a clearly negative impact, mainly through mark-to-market losses on fixed income securities. Just to give you a number, in global reinsurance alone, global reinsurance, this impact is estimated to exceed $100 billion for 2022, $100 billion of mark-to-market losses. Now, how can insurers respond to these challenges? First, they can offer more affordable products in order to take into account the cost of living issues that an increasing number of customers are facing. Second, they can improve operational cost efficiency. Of course, this is a permanent challenge. This is a permanent imperative, but you can argue that in times of inflation, it is particularly important because any progress on that front would enable insurers to show more flexibility as far as the third item here on this list is concerned, the repricing of insurance business. The repricing of insurance business, of those businesses with elevated claims costs, this is a must, this is an imperative to maintain, to safeguard the insurance industry's solvency. At the same time, it is highly sensitive given where we are in terms of eroding real incomes, in terms of cost of living issues. And last but not least, the all-important claims function. Here there is much scope for strategic responses, such as an expansion of partner and supplier networks, which would allow insurers to lock in prices for a longer period of time. Now, moving to the next slide, which discusses the impact on insurance demand. The macroeconomic consequences of inflation, such as higher interest rates, such as lower economic growth, are clearly negative, are negative for insurance demand. There can be no doubt about that. When we look at life insurance, the picture is a bit more complex. Yes, of course, inflation erodes the value of future fixed payouts and therefore diminishes the attractiveness of life insurance. But at the same time, the normalization of the interest rate environment is a boon for life insurers, not only as asset managers, but also as providers of certain products, savings products, which become more feasible and more attractive to customers. The third point I would like to make is that, and the paper is making actually, is that more structurally, insurance demand could benefit from customers' changing perception of risk. As I mentioned before, the current inflationary experience came as a shock for most of us. It was not anticipated. And when we look back to the pandemic, we can observe the impact that shocks can have when you think of the sustained effect of the pandemic on health insurance demand, for example. And the final point I would like to stress here is that the value of insurance arguably increases in times of inflation. Why? Well, first of all, financial risk protection as afforded by insurance becomes more important as people experience more financial stress and many more financial constraints. The second point, the role of insurance in loss prevention alleviates the financial burden from uninsured losses. And let's not forget that most losses are uninsured, and they are particularly painful to absorb in times of rising prices. And last but not least, financial intermediation. Very important role of insurance more generally, but especially now where savings products, investment products can help policyholders avoid the value erosion on their cash deposits. Let me stop here, and without any further ado, I would like to open the floor for our panelists, for our speakers. Starting with Lee. Yes, thank you. Lee will share Swiss Re's current economic outlook and will also discuss the implications for insurance claims costs. Lee, the floor is yours.
Thank you, Kai. Can you hear me? Okay, thank you very much. Good morning, good afternoon, good evening, everyone. My name is Lee. Just Kai introduced. I relocated from Beijing to Zurich 2 years ago. So now I'm the head of insurance market analysis based in Zurich in Swiss Institute. So it's my pleasure today being here to share and exchange our views on related to the microeconomy as well as the impact on insurance industry around this very interesting and very important topic. So two connected parts will be covered from my side. The first one, the micro perspective. So what's the outlook for global microeconomy and the trend of the inflation this year and next year? The second angle I will share is on the industry. So how severe and what implication related to this topic to insurance, especially, the drivers behind the hardening market we are seeing now. So firstly, on macro side, you will see the fingers on these slides, right? We see the economic trends are still weak, but it's better than we expected. Recently, we had some hard data just released, right? From that, we see the global economy is more resilient than we expected before. But, we still say the global recession is still there, right? And, we see the driver of the recent recovery of the global economy is one of the reasons is the mild European winter. The second reason is, the Swiss China reopening. So this kind of the very important two factors support the global growth recovery. But from other side, we cannot judge at the current stage the global will recover since now. We still say there's the significant global deceleration in this year. So in terms of the inflation side, we see the sign of easing. But we still forecast the inflation to remain persistent and above the policy target level in this year and next year. So inflation risk is still there, especially when China reopening, right? And, that will delay the process of inflation decline, the whole process. And, we also say from US, the labor market is also very hot. So two kind of the things also push up the inflation, not decline so soon, still, persistent and sticky. In terms of the interest rates, we say that's kind of the silver lining facing to the whole industry. So the monetary tightening to continue, although we expect at a slower pace and lower increase. All in all, right, from our perspective, we see the likelihood of near-term positive scenario increased to some degree, but it's still too soon to judge, global will be recover very soon. It's very optimistic time for us. So it's still very soon for us to judge in terms of this kind of the statements. Now, the question is how those micro, dynamics can be reflected into insurance industry. As Kai mentioned and also mentioned in the report, right? We say in the last year, the inflation surged, then we, much higher than we expected. And, this thing is not occasionally. In fact, we see this kind of the trend has already happened since 2021. And, last year, that's the peak time of the inflation. So from our perspective, we also want to translate the microdynamics into insurance market. The very important thing I want to emphasize 3 times, right? Inflation, inflation, inflation. This is still the big concern, for the whole industry. Either, we say the peak already passed, but for this year, we still say that's a bigger concern facing to the industry. As we know, different line of business, right? They have the different reaction to economic inflation because of the coverage and features of insurance policies are totally different. But we say at the current stage, especially when one might inflation shock suddenly, right? The most affected line of business will be the non-life. And especially we say the high price in car parts, in repair cost, as well the construction related cost, right? Those things are all, negatively have the impact on the motor and the property line of business. For some long tail business, such as the such as the carry line and liability line, if the inflation persistent and sticky, right, will be continue long time. So those kind of the line with the features of long tail, they will be more affected, especially when we forecast the wage and the healthcare related expenditure will going up continually. So the long tail business will be affected mostly. In this case, right, we also mentioned in our reports, the most affected line of business will be non-life. For life is neutral. One of the reason is can also mention the headline CPI and core CPI. So for the core CPI, we don't include the fuel, food and energy prices. Those kind of the elements are relevant to our life, but they are not a primary driver to the claim of the non-life business. But to some degree, they will have the impact on our purchasing power. So to some degree, they will define the demand of the firm and household on insurance. From our side, right, apart from the impact and the reason why the high inflation have the negative impact on different line of business, we also want to do some the quantitative analysis on the sub indicators related to inflation, on the cost and the claims related to the different line of business. From our perspective, we observe, right, the overall CPI climb very fast, especially the construction cost. From the graph on the right, we can see, especially in Germany, the construction cost, very crucial and very, climbed to 20%. That's higher, very higher than the overall and general CPI. So this kind of the thing is very crucial for property lines. And, we also say because of the destructive supply chain, the motor repair cost, as well the prices for new vehicles and used car, they also, very key for motor business. So in this case, based on our experience, we estimate the cost related to this kind of the sub-index related to inflation, and also, had a very negative impact on motor and the property line. For healthcare expenditure, right, that's also have the negative impact on the health, PA, and the liability lines. And we also use wage to present income compensation cost. This kind of thing is very matter to the health, PA, and the liability line. So, this kind of elements also relevant to the operational cost related to property and motor line. So given higher prices for those components in last year and this year, and the weights, based on our experience and our book, right, we set for each line, we also estimate impact of the inflation on insurance claims. So we select several markets here: Germany, France, UK, Australia, and US, right? This main market, based on the weight and also based on the, the actual inflation figure. And we estimate how severe the impact of the inflation on this on the PNC line and on the property commercial line for these selected markets. And we also have the strong consumption. We also had a very strong assumption behind that. For example, we said the exposure won't change over near time, right? So in this case, we have the findings. Overall, the impact of the inflation on the cost and the claim will increase around 10% for the main markets. So that's the results, right? If the claim frequency also change, For example, last year we see the Hurricane Ian, and the increase in the cost and claim would be even greater. So those kind of the increases, however different, different line and different market, but everything in our mind we have to consider is the how insurer reacted to this, the surge in claim and costs. I will stop here. That's something from our side to introduce the impact of the inflation on different line, and we also give some the color related to the quantitative analysis. So can I hand over to you?
Thank you so much, Lee, for painting first the macroeconomic picture with which seems to offer some upside, and also drilling down into the shifting dynamics of the cost drivers across claims cost drivers across various lines of business. So let's move from economics to corporate strategy and product development. And I would like to invite Rachel to elaborate a little bit on how insurers have responded to this inflation, to the surprise inflationary experience, and how they are still responding. Rachel, please.
Thank you very much. Thank you. Great to be here. And I thought I'd also just share a little of my background. I'm the group head of strategy at Beazley, but I also worked as an underwriter for many, many years, leading the US directors and officers team here. So a lot of my comments are coming from somebody with an underwriting background. And so I'm looking at this through the lens of an underwriting background, and then also from on the strategy perspective. So when you think about how are insurers responding to inflation, how have we? I'd put it in two buckets. One is short-term tactical, and the other is sort of a longer-term structural question. So when you think tactical, there's tactical fixes, building it into the rating environment. Now, on some lines of business, total insured values increase when you have inflation, so therefore pricing may well reflect that. On many other lines of business, pricing is a function of supply and demand, and therefore really what you're building into the rating models is a view on rate adequacy, rather than necessarily that pricing will increase just because inflation is going up, but your rate adequacy might decrease. Also, obviously, we've seen insurers allowing it for reserves, especially on the longer tail lines, looking for that structurally and increasing the reserves that are being held for the higher cost that will come through. But it's not a broad brush approach. I think really most insurers, are much more sophisticated and taking it by class impact, as Lee's just gone through. Not all classes of business are affected equally by inflation, so it's had to be a very nuanced approach. It's worth remembering, and I think Kai said this in his opening remarks, but the headline sort of CPI that we see doesn't entirely correlate to the inflation that insurers are even seeing anyway. So there are elements of that headline number that really doesn't impact insurers, and therefore, and again, impacts different lines in different ways. The other sort of tactical piece, less now about underwriting, but more about running the business, and this is not specific to insurance. This is going on across the world, but wage inflation. So we've all been, when I look at the amount of the average pay rises that are going on, people have generally been quite careful of giving themselves a longer term problem. So majority of pay rises, certainly in the UK and US, have been around about 5%. And then a lot of companies have done, a one-off kind of cost of living adjustment, or larger salary increases for those in the sub sort of £75,000 or dollar bracket, because that's really where the cost of living or the inflation is really biting in that area. So, but I think when you're looking at that tactical piece, there's been an eye to the longer term structural element to make sure that we don't give ourselves a problem for the future. When I move on to longer term structural, inflation pushes the need for automation. Now, we know as an industry that we have, many of us have aging or costly infrastructures. And automation obviously can reduce costs, and the more you can reduce the cost, the more you're able to offset the impact of inflation. And I'm not just talking, when we can talk about automation, you can just think it's end-to-end automated quoting, buying, trading systems, portals, APIs, and therefore think, well, that's actually a problem for digitally traded risks on the sort of more SME part of the market. But really, there's opportunities to automate part of the manual underwriting process on the large risk piece with much better data. There's obviously many back office efficiencies to be gained as well, which is often the focus that we're seeing right now coming through. And by no means do I think that this is easy. It is a really hard job to automate, But inflation gives, I think, a much needed push to the industry to really embrace automation, because it is a great way to offset some of the costs. And then the other structural piece that you see is really, in my view, a focus on innovation. I'm looking at this from addressing the protection gap that we talk about quite a lot. Does inflation increase the protection gap? Not necessarily, but I look at the insurance industry and say, if we look, roughly 80% of the balance sheets now aren't insured. We run the danger of walking ourselves into oblivion if we don't try and address this. And if insurance demand, as Kai mentioned, is fundamentally impacted by inflation, we need to ensure that any of the demand that still remains is actually being addressed by products that people want to sell, and is actually really just covering more of the balance sheet. So with that, they're my thoughts, and I'll hand back to Kai.
Thank you so much, Rachel, also for introducing an underwriter, the former underwriter's perspective. I should have mentioned this in my introduction. Turning to Manuel, Manuel, who is an acknowledged expert, not just in economics, but especially in issues affecting emerging insurance markets. Emerging insurance markets have long dealt with inflation. For many of those markets, it's not something unusual to have to deal with double-digit levels of inflation. So we might be able to learn something from their experience. Manuel, could you elaborate a little bit on your perspective on that? Thank you.
Yeah, sure. Thank you very much, Kai, and thank you very much for the invitation to participate in this webinar. As it has already said by you and by Lee, nowadays inflation is a very synchronic process worldwide. But this is not really different from what has been happening throughout the last 50 years, for instance. If we look at the recent economic history, emerging markets, however, usually tend to amplify the effects of the inflationary episodes, as you mentioned, compared to what happened in developed markets. So in general, inflationary episodes are usually more profound with a longer duration in emerging markets compared to what happened in developed economies. This behavior is particularly clear when we look at, for instance, what happened in the decades of the 80s or 90s of the past century, when in some specific moments, almost every economy worldwide presented high rates of inflation, while in emerging markets, many economies presented hyperinflation episodes that implies huge challenges for the insurance industry. As you have mentioned, and also Rachel and Lee, inflation has various effects on insurance markets. Of course, looking, for instance, on the non-life segment, from macroeconomic perspective, of course, there is an impact in terms of insurance demand. The implementation of restrictive monetary policies implies a negative effect on the economy, and therefore there's also a negative effect on the insurance demand, basically in this line of business, which is more closely linked to the economic cycle. And from the microeconomic perspective, there's also an important impact that has been already mentioned. That is the increase of costs, both claims and operating costs of insurance undertakings, as an additional pressure that should be dealt. So this adjusted cost of the structure not necessarily is compatible with the premium charged to the current insurance products, and therefore there's a pressure for increased technical provisions and necessarily to adjust the price of the insurance products. In emerging markets, this latter effect, the effect on the cost structure, is particularly important in terms of the lessons learned. In emerging markets, because of these hyperinflation episodes, insurance companies have to fight against not only the effects of traditional orthodox measures, economic measures to deal with inflation, but also some unorthodox measures, such as prices controls, for instance. So this implied a very important pressure in terms of the pricing of the products and the proper technical performance of the insurance company. But even, as you mentioned, Kai, in peace times in emerging markets, emerging economies are used to live with relative moderate level of inflation. For instance, 3-4%, that might be, in fact, in line with the targets of the central banks. Used to be, I mean, a normal, a day-to-day situation that you have to live with. So the stress in the cost control is very important, has been very important, and has been internalized in emerging markets of insurance as a part of the day-to-day business, and as a part of the necessary control of technical performance. So, in a sense, this situation with level of inflation with 7 or 8% is not really so stressing in terms of the cost structures compared to the peacetime situation. In the case of the life insurance, it's quite different, as it was mentioned before. Of course, it has some impact in terms of the insurance demand, because I mean the negative effect on the economy also implies a reduction of the personal disposable income, and by extension on the saving capacity of the population. At the end, life insurance is a mechanism for saving for families and individuals. But probably the most important impact of inflation on the life side has to do with the product itself. And it was also mentioned that usually in traditional life insurance, the benefits, the insured sum, for instance, is set in nominal terms, and inflation reduces in real terms the value of the benefits of the life insurance. So these may create this neutral effect. However, it also creates some unintended effects on the consumer side, and this is that probably may create and establish in the paper of the Geneva Association some kind of frustration amongst policyholders that are seeing that the benefits are being reduced because of the effects of inflation, and at the end, this may imply as well a reduction in future demand for these kind of products, and a potential increase of reputational risk for insurers. In emerging markets, the lessons learned from this specific issue of the benefits of traditional life insurance implied more dramatic lessons, really. In fact, hyperinflation episodes in many emerging markets produce almost the disappearance of life insurance in some countries such as a saving instrument. So there was no attractive in saving in an instrument in which the money that policyholders were putting there almost vanished from one day to another. So it was necessary to innovate and try to modify products in order to regain confidence of customers and to rebuild life insurance in emerging markets. And this was done in different ways. Probably the most popular was to link the benefits of traditional life insurance policies to a hard currency, for instance, the US dollar. That was a proxy that could protect the value of the benefits in the policy against the inflationary effects. Another way was to use the so-called inflation indexed units of account. As you may know, in many emerging markets, governments create these kind of units of accounts for different purposes of economic policy, and this unit was used by insurance companies as a way to reflect benefits in real terms. So these benefits could be moving as inflation was moving in the economy, and also, of course, the premium should be paid according to this unit of account. And in some others where the governments were not able to create these units of account, insurance companies themselves create their own unit of account. So they establish this measure in the insurance contract, and the benefits were reflected in this kind of things. This is something, and I should say that even in peace times, again, in controlled situation of inflation, it's very usual in emerging markets, and it's the base that was used in order to regain confidence and to rebuild life insurance in emerging markets. I will stop here, Kai. I'm sure there will be an opportunity to discuss a little bit further later on. Thank you.
Thank you so much, Manuel. Before I will pick a few questions from the floor, and we have received a number of questions. Let me dig a bit deeper into a number of aspects which I would like to discuss with all of you, all three panelists. Maybe starting with the most difficult and arguably most important question: what will be the longer term impact of this inflationary episode? So at some point, central banks will have vanquished the current bout of inflation. what will last in terms of effect on insurance demand? Maybe, Lee, may I start with you from an economics perspective? Would you expect the longer-term impact of this experience on inflation demand, on insurance demand?
Okay, definitely, Kai. Thank you for this very interesting question. You know, from our perspective, we see the impact of the inflation has has two sides, right? The one is, you know, high inflation will also give the pressure on the cost of living, as you mentioned in the beginning of this seminar, especially on household, right? And, you know, as we know, insurance is not necessary for most commercial insurance. That's not a necessary necessity for household or for company. So, from this perspective, if they want to cut one of the expenditure from their perspective, they usually cut, you know, the expenditure on insurance. So yeah, so if the inflation continue or persist longer, that's a very positive. That's very, you know, negative impact on the demand on the insurance. That's on the, especially on life. And for the non-life, I understand, you know, that usually depends on different line of business. For example, if we last year, the inflation shock, you know, suddenly appeared. So the property line, you know, suffered a lot and suddenly. And, you know, we see this year, the inflation is still sticky. So we forecast long-tail carry business, you know, they will suffer a lot, especially, you know, inflation is not a big issue, but still higher than the policy targets, and together with social inflation. So the long tail business of carry and, you know, motor third-party liability, something, they will suffer a lot. So from the longer perspective, I see, you know, quite negative for industry, you know, developments. But from other side, right, that's also good for the nominal, right? Because everything is increasing, especially, you know, for the nominal growth rate for premium. So we say that's a good thing for the premium, but you can squeeze the water from this the nominal growth, right? The real growth rate was really hurt. It's really hurt, you know, by the inflation, higher inflation.
Yeah. Thank you very much, Lee. Digging even further into this from a customer's perspective and addressing this question to Rachel and Manuel, who are or have been very close to the customer. What would you expect in terms of evolving customer needs in the face of this inflationary experience? Is there scope for new, for different, for innovative propositions? What will it do to the nature of demand longer term?
I'll happily jump in on that one first. I think firstly I'd say I'm possibly slightly more optimistic than Lee is, in that actually longer term, if you're talking 5 to 10 years, I just think we've got really short memories in the insurance industry, and we'll probably forget this really quickly, and we'll go back to doing what we've always done, for good or for worse. So I don't know how sustained it will be on customer behavior and pricing behavior and buying patterns and demand. In terms of, you know, when we think about innovation, is there, you know, customer changes in behavior because of this? I'm not sure that it's inflation that's going to drive changes to customer behavior. Economic inflation, I do think social inflation, which Lee mentioned, is a bigger challenge, certainly in the US casualty space, in terms of driving behavior. But I don't know, maybe I'm overly optimistic, but I think that we'll forget about this episode sooner than we would like to imagine that we should.
Thank you, Rachel. Manuel, anything to add from your perspective?
Well, I see two main, let's say, structural foreseeable changes. One, from the macroeconomic perspective, I think that we have to be clear, and you mentioned in your initial words that what we have seen in developed markets throughout the last couple of decades is not really the normal situation of very low environment of a very low interest rate. So I think after this inflationary episode, there will be a normalization of monetary policy that will end up in a situation in which interest rates of the monetary policy will be positive at least. And this will be, I think, a structural change for life insurance in developed markets, which were in a very funny and unusual situation throughout these last years. And the second one, from the microeconomic perspective, has to do with the with the issue that was raised before. I think, as any other economic event, inflation, it's a call for innovation. In not necessarily huge innovation, but the call that these kind of events are not one-time events. I mean, inflation is not going to live forever. It will be they will reappear in the future. I'm sure of that. And this is something that the insurance industry should be learned from in terms of the design of the product. So, for instance, as in the example I put on the emerging markets, the benefits of life insurance policies could be protected against these foreseeable situations in the future.
Thank you very much, Manuel. Let me, as a second item I would like to touch upon with all of you, let me address the issue of repricing, as mentioned before. Maybe Rachel, starting with you, what do you consider the main pitfalls in the context of repricing, and what can insurers do to avoid those pitfalls?
So I think the biggest challenge is affordability. So we've talked a bit about affordability from the policyholder, whether that's an individual policyholder or a corporate policyholder. We know that costs are going up. So if insurance, and when I mentioned as well in my opening remarks, with the protection gap, which for me is a real area of concern. If you have the protection gap where insurance is becoming has the potential to become less relevant overall, and then you price yourselves out of affordability for your clients, then those two forces, it doesn't paint a great picture for the future of insurance. I think what we need to do as well is remember that insurance works best when we build long-term relationships with our clients, and that we're there throughout a cycle and they stay with us throughout a cycle as well. So, sort of avoiding that temptation to take the full inflationary impact of a price increase because you can, that probably doesn't in the long-term interest of the client. It is in the long-term interest of your relationship overall with the client. So I think we want to be conscious of being very client-centric when we're doing here, and recognize the challenges that our clients will be facing as well. And is there a word that I'm not suggesting that we should write unprofitable business, but is there elements where we could maybe reduce our margins slightly such that we can help clients through a cycle? So for me, it's the big message for me is looking at this on a longer term partnership basis rather than individual year-by-year pricing of risk.
Yeah, thank you, Rachel. You mentioned protection gaps. Lee, the Swiss Re Institute has done a lot of research on protection gaps in terms of quantifying them, in terms of exploring them. Have you looked at the impact of this inflation episode and the longer term, the macroeconomic paradigm shift that we are seeing currently, the impact on protection gaps? Have you looked at this, or maybe even by line of business? Where do you see the link between the current macroeconomic environment and the future nature and size of protection gaps?
Thank you, Kai, for this very good question, right? And for our insurance resilience index, we indeed have 4 sub-index. We have the NatCat resilience index. We also have the mortality, health, and now we are also developing a new the agro-related, the resilience index. So you can see we define the protection available and the protection needed for different line of business. They have the different, the variable collected to fit the calculation. So, for example, for the NatCat, we see there's a very close link between the resilience index, for insurance industry and the macroeconomy. Especially, in our recent simulation, we found a higher, the price of the construction-related material. They really push up, the claim related to the NatCat property insurance. So to some degree, that's also, make the protection gap related to NatCat, also bigger than we expected, especially for last year. For this year, is because the inflation is already easing, so we see the situation will become relaxed to some degree, right? But the inflation is still higher than the policy target, so we still see the potential risk is still there. So that's the thing. And from our perspective, we want to high inflation and lower disposable income, and the fluctuation in the wealth, the value, something like that, right? That's also the variable we consider in our protection gap. So you can say if the macrodynamics changes and high inflation or interest rates is also changing, the results from the calculation of the protection gap also, change. So that's a very close link. And yeah, that's also definitely have the, impact on the, insurance industry. But we say the bigger protection gap, also the opportunity, right, facing by the insurance industry, how to meet, right? I want to link the message, Rachel gave us, innovation, right? And, the build up the long-term relationship between with our clients. That's also all kind of thing to meet the, protection gap.
Thank you very much, Lee. Let me now turn to some of the questions that we received from the floor. One question is about anti-selection, repricing, anti-selection. How do you deal with the challenge of anti-selection when you adjust terms and conditions, when you adjust prices, when you adjust benefits? Who can share some insight on that challenge? Rachel, maybe?
Yeah, I can
volunteer you?
Yeah. I don't think that anti-selection is always going to be a risk when you change any terms and conditions. Typically, the insurance market tends to move as a block. So it's rare that there's one insurer that's doing something that's so radically different from the rest of the market. I mean, it happens, don't get me wrong, it does happen, but it is more unusual. And in something, if we're just talking specifically around inflation and therefore reaction to inflation, it's such a well-known macro issue and what we're seeing is that most insurers are taking a very similar path. So I think your anti-selection issue isn't as so much of a risk at that point in time.
Mm-hmm. Thank you, Rachel. I have a macroeconomic, non-insurance specific question for Manuel. The increasing interest rates in the advanced economies are weakening the exchange rates of emerging markets. And even if we see low inflation in China and declining inflation in markets like Brazil, weakening exchange rates can be a source of rebounding inflation or a source of persistent inflation in emerging markets. What would be your take on this question, Manuel?
Well, I fully agree. I think that we haven't seen the end of the picture in terms of the effects of the monetary policy as a means to control the inflation. One of the things that we will have to look at very carefully is exactly that. What will be the final effect in terms of the movements of capital, for instance, between developed and emerging markets, and the effect that this will have in terms of the exchange rates. As you know, in emerging markets, one of the main structural sources of inflation has to do with the so-called pass-through effect through the exchange rates. And this will be an element that will generate additional pressures in prices in emerging markets when this phenomenon might be reasonably controlled in developed economies. So yes, I fully agree that this is something that has not yet ended, and we will have to see what happens in the very near future.
Mm-hmm. We have received a question on the investment side of things. So far, we have only talked about the liability side of the balance sheet, the inflation's impact on insurers' assets and the differences in impact for life versus non-life insurers, short-term, medium-term, long-term. Lee, would you have an opinion on that, on the investment side of things?
Yeah, thank you, Kai. From our observation, right, assets also have the impacts related to the inflation. One of the reasons is, the central bank, they want to fight back the high inflation. So to some degree, they are tightening the monetary policy. That's also to some degree push up the interest rates. So from the mid and long-term perspective, that's good for the asset management, right? Especially for the, for the life, because, that's a long duration business. But in the short-term perspective, that's also, creates a volunteer of the capital market. So recently we see the insurance market, their assets, especially their equity valuation also, decreased. One of the reasons is higher interest rates. But, from our research, we see from the medium and long term, right, especially for PNC side, they have the short term the business. So it's easy for them to do some the reinvestment, taking the chance of the high interest rates in the capital market. For the life insurance, we also say, just I mentioned before, we also see there's a good chance that's a saving, that's also the silver lining for the whole industry to improve their asset management. And if the income, especially for this year, right, not only the hardening market continue for PNC side, we also say the insurance market, they can benefit from the improved asset, investment income. So to some degree, the improved income from the investment can buffer, some pressure on the liability side.
Thank you, Lee. Let me we have received one interesting question on products with guarantees, products which might become more feasible, more sought after by clients. But still, we have the high cost of, the burden of regulatory capital requirements under Solvency II, for example. What would you, maybe Manuel, as a former regulator, do you see given the changing macroeconomic environment, and let's assume that interest rates are normalizing, would you see a case for adjusting these tight solvency capital rules, which were designed in times of very low or close to zero interest rates?
Well, yes, I think that in every important change in terms of the performance of the economy, it is important to reassess the level of risk of each one of the different kind of investments for financial intermediaries. I think that the key on the success or the future success of these kind of warranty life products has to do with trying to find, from a regulatory viewpoint, the neutrality between different financial options. I mean, probably there is some inherent risk linked to certain kind of investment that should be reflected in capital charges, but these capital charges shouldn't be different from insurance companies to other financial intermediaries. So there will be neutrality in terms of competition. But again, I think this should be reassessed by regulators.
Very good. So maybe we can go back to various components of claims cost inflation. Looking at one of the questions received here, I think it's specifically for you, Lee. Talking about medical inflation, why do you think it will be above average or could be above average in 23?
Yeah. That's also the thing, right? We are discussing. I also want to share my views with you guys. I know you are the expert in this area, so please correct me if my understanding is not correct, and if you observe more, the facts in the market. From our perspective, medical related prices as well as the wages, they usually lagging behind the overall the CPI. So that's why that's the spiral path for this kind of the thing, right? Especially when we push up the general CPI and we see, the wages and medical related index and healthcare related expenditure will also, increase afterwards. So that's a thing we forecast for this year. That the further increase in the medical. And I have to say, right, medical is still medical related inflation is very key for the health business as well for the the motor related business, right? So in this case, we sense the medical the motor, especially related to body injury and the health related insurance, that the claim, they will also have impacts, negative impacts related to this one. Mm-hmm. So that's the thing we observe and analyze from the trend of the inflation change.
Thank you, Lee. Now I have a question that I know is close to Rachel's heart, and I think Rachel briefly mentioned it already: social inflation or superimposed inflation. What are the prospects for this phenomenon now in light of increasing consumer price inflation, of the social stresses societies are going through? What is your outlook on social inflation, Rachel, and maybe the others as well, if you have views? Thank you.
Yeah, thank you. So I'm far less optimistic on social inflation than I am actually on economic inflation. I think it is a phenomenon that's here to stay. I think it's driven. If I think about what drives social inflation, one of my views is it's almost like an outrage inflation. With increased outrage, the desire then to punish companies for doing something wrong through jury trials, or the fear of going to a jury trial is what's driving that increased claims cost. With cost of living challenges and a greater economic disparity between the very rich and the very poor, actually drives that outrage even more. So therefore the desire to punish these the deep pockets comes even more to the fore. I don't see that changing. We obviously saw social inflation take a little bit of a pause in the US when the court systems pretty much froze up through COVID. And broadly speaking, what we're seeing is most insurers are putting in around about, I think it's about 8% annual load of increase that of the social inflation is adding. I think that's possibly a trailing indicator. If you actually look forward, I think it's picking up in pace again. So social inflation for me, for US, especially for the liability lines, really challenging. But again, as I've said before, not all lines are created equally. Some are highly exposed to social inflation, some have a medium impact, and some are just not exposed at all. But for those that are highly exposed, I don't see any signs of that abating.
Thank you, Rachel. Lee and Manuel, do you have views on this topic of social inflation? Please. No further views. Let me just take a look at the large number of questions and comments that we have received here. Well, we have a life insurance specific question talking about lapses, the increase of the lapse risk due to more competitive investment alternatives. I mean, maybe Manuel, judging from your experience, have you seen this effect? And if not now in the current phase of inflation, maybe in previous inflationary episodes?
Sorry, Kai, could you elaborate a little bit more? So I didn't get, because I have some problem here with the transmission.
No, it's about the phenomenon of lapses, increased lapses as a result of the availability of more attractive investment opportunities, but also in light of the eroding value of fixed nominal payouts. What is your experience with lapses? Maybe also remembering your former stint, long stint as a regulator.
Yeah, so at least most emerging markets, this used to be a very usual behavior of consumers. So when not necessarily in inflationary episodes, but in general in economic crisis, when the difficult economic situation implies the need for more liquidity for consumers. So they look at different. In one case, it's just the need to have liquidity and to get out from some kind of investments, and in some other, like inflationary episodes, when you can see that there might be alternative ways to invest that might be more profitable than the one that offer insurance companies. This is a quite usual behavior, and that's why I stress on the need of innovation, try to avoid this kind of features of life products that creates or that enhance these kind of behaviors.
Kai?
Lee?
Yeah.
Yes,
thank
please.
you. Yeah, just as Manu mentioned, right, the financial crisis, high inflation, and the recession will cause the disposable income will reduce, right? That's also caused the lapse risk or surrender risk from the consumer behavior. And nowadays we also see the rising interest rates, and the consumer have the different selection or choices for the higher the guarantee product. So in this case they will also have the risk related to the lapse. But we say that's the major risk facing to life insurance this year, especially we are facing the higher, the rising interest rates. But, from our observation, the risk has not materialized yet. So, yeah, so it still need to be, monitoring or tracking, right? Whether we say that's a risk indeed, but, that's not really, materialized. So we will say how the digital adoption or digital solution can help to reduce that kind of the risk.
Thank you very, very much. Unfortunately, I have to wrap up. We are at the end of this I think very, very exciting seminar. Let me give you my perspective on the key takeaways, just a minute or two. We have learned from Lee, or we have heard from Lee, that the macroeconomic outlook is less grim than it used to be 3 or 6 months ago. There's an upside also for the insurance industry. At the same time, claims ratios will remain under pressure for reasons such as the wage growth, medical inflation, and social inflation. In terms of the responses, Rachel introduced, I think, a very, very pertinent distinction between short-term tactical answers such as repricing and longer-term structural responses such as automation and innovation. This is also a theme that we heard repeatedly during this seminar. So this inflationary environment and the new macroeconomic paradigm could boost innovation across the insurance value chain. And finally, the longer-term impact on insurance demand. Manuel mentioned the normalizing interest rate environment that could have a more permanent impact on the nature and extent of insurance demand. And then from a microeconomic perspective, also again, a call for innovation, a need for innovation, more scope for innovation as a result of this inflationary experience. Thank you very, very much. I would like to extend my gratitude to our panelists. I'm sure I can speak on behalf of all of the participants in the seminar, in this webinar. I would like to thank our esteemed viewers for their many questions, and I do apologize that I could only address a fraction of those. Before I conclude, I would like to raise an important request. Please do provide your feedback in our short pop-up survey, and do not hesitate to come up with specific ideas, specific suggestions, specific thoughts on also what we could do differently going forward to better meet your areas of interest and your needs. I can assure you the team sits together after each webinar and goes through each and every comment. So please take the time to provide us with your feedback. With that, thank you very much. Thank you for your attention, and goodbye.
Thank you, Kai. Bye-bye.